No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to talk about a few things today that you want to be prepared for. All right. First, we'll start out with something to ask yourself. It's kind of a little bit of a trick question, but think about this: what would happen if you lost your job and were out of work for 30 years? Right? For most of us, of course, that would be devastating. What would we do? And yet, isn't that retirement? What retirement is? When we retire, we're going to have 20, 25, 30 years, maybe more, in retirement. And that job, that income from those wages, those are going to be gone. Do we want to be just dependent on Social Security alone? Are we going to be able to maintain your standard of living and your quality of life just on Social Security? And what if you maybe have even a pension? Is that pension and Social Security going to be enough to maintain your standard of living, quality of life, to enjoy life and do the things you want with your family, okay, and your friends and your community and the things you know that mean the most to you? So, if there's a way, and there is, right? This is the good news. There is, in fact, a way, and I use this strategy all the time with clients that come in to see me, and that is how to, in fact, replace that income to make sure you're going to have enough income to never run out of money during retirement. You see, it's not about just accumulation and becoming rich. How many times have you seen people that become rich and then, I mean, the story's right, people, lottery winners or celebrities or sports stars and the like, they become wealthy, and then what happens? They lose it all, and they find themselves destitute, broke, no money. Okay? We don't want that to happen. And is that really then, it goes back to, again, the question about, is it about getting rich, or is it about never being poor? Is it about making sure that you have enough income to maintain your standard of living and quality of life no matter how long you live, to take care of all your financial goals, all the things for your family, to make sure for a couple, if one predeceases or when one predeceases the other, that the survivor is also able to maintain their standard of living, quality of life. You know, this is one of the things we have to look at today. There's something now called longevity risk. All right, longevity risk is, if you think about it, it's this. Basically for a man, all right, for us men at their average age, about age 82, 83 now, okay, is how long we're expected to live. For a woman, about 86, 87. Right? So women, of course, and have for many years, lived longer than men. All right. So have you taken it for a couple then? You've really got to give thought to those kind of considerations. And when it comes to planning, it's not, these are just general, you know, when it says that the average is going to be that means half the people are going to pass before then, and half are going to live beyond that time. More and more people, I think the number's around 25%. Are living beyond age 100 when we look at a couple age 65. All right, so one of the things that we're looking at is how do we make sure we don't run out of money? How do we make sure, in fact, that we're able not to just not run out of money, but to be able to maintain our standard of living, our quality of life, to continue to be able to do the things we want to do no matter how long we live. And this is the other area we've talked in recent weeks about healthcare concerns, right? About the healthcare costs and what we do there. Well, this is one of those areas, like with Social Security, Medicare, and still having those health care costs, substantial health care costs, $250,000, $300,000 potentially per person in retirement, the out-of-pocket part that you're going to have to pay, even with Medicare and supplement plans. So how do you cover all these risks? And this is where having that guaranteed income can be very important. Another is how you invest. All right, one of the areas here when it comes to investing, I'm going to show you a slide. This one is the Dow Jones Industrial Average this year. Okay, this is for January, and you notice the Dow was down about over 10% in the first month of the year. Now the other thing, let's take a look at the next slide, the S&P 500 index. So the Dow Jones, that's the blue chips. These are the best companies. Then you've got the S&P 500 index. This is the 500 largest companies in the United States. They make up about 70% of the equity in the stock market. And guess what? They outperform 96% of equity mutual funds in the market. So think of that. Keep that in mind, because the S&P in the first month was down 10.5%, which would mean that for about 90% of equity mutual funds, they were down even more than that. Now, since then, what's happened? In the last 2 months, finishing out the quarter, the S&P and the Dow Jones have recovered to where we're up about 1%, give or take, for the year to date. That's a lot of volatility, isn't it? To go down 10% and then up 10%, all in the course of a few months. We haven't seen that kind of volatility since 1933. So what we're finding is that there are strategies, however, that you can employ. There are new investment strategies that are specifically designed for times like this, to help you, in fact, in that volatility. So imagine, for an example, okay, let's take a look. Some of the strategies I'm going to share. One's called the Shiller-Barclays Cape U.S. Sector. Okay, this is developed by Dr. Robert Shiller. He won the Nobel Prize in 2013. And then the next slide is the J.P. Morgan Mosaic. So these are some of the things we're going to talk about. The J.P. Morgan Mosaic is these are two new strategies, the Shiller Index and the Mosaic Index, that people are using now, or are available to us now, I should say, to help smooth out volatility like we're seeing today. So imagine, as we get into this, imagine that you could invest in such a way that when the market is down, you would be able to still make money. Is that something you'd be interested in? Well, then you'll want to definitely stay tuned. We're going to take a quick break. Join us here. We'll be right back on the Retirement Report.
This is a Storm 5 HD weather update. Sign up for Weather Call at newschannel5.com.
Hello, everyone. I'm Ron Howes from the Storm 5 HD Weather Center. You're looking at radar now, showing the thunderstorms out there on this Storm 5 alert night. And temperatures across the southeastern U.S. The current conditions now in Nashville. Forecast for tonight, a continued chance of thunderstorms throughout the evening hours. Some of those thunderstorms could have large hail, damaging winds, and even a few tornadoes are possible. So stay very aware of rapidly changing weather for tonight. Overnight low of 58 degrees, and then as we move into tomorrow, we'll see calmer weather, a high of 70. Over the weekend, temperatures in the low 60s. Nighttime lows Saturday night down to 37. Another rain system possible on Wednesday and Thursday of next week. This has been a weather update from the Storm 5 HD Weather Center.
The Amazing Race is back.
Let's go!
With a staircase that'll take your breath away.
There's a lot bouncing on the boobs.
New Amazing Race, CBS tonight. It's the ACM Awards with superstars Garth Brooks, Tim McGraw, Florida Georgia Line, Carrie Underwood, Blake Shelton, Martina McBride, Keith Urban, Little Big Town, Miranda Lambert, plus a not-to-be-missed duet with Dolly Parton and Katy Perry. Join hosts Luke Bryan and Dierks Bentley. The Academy of Country Music Awards live, CBS Sunday.
What do robots, smartphones, and guitars have in common? Yep, they're all made right here by manufacturing professionals. And that's just the beginning. The manufacturing industry is growing in Tennessee, and well-known world-class companies are looking for people just like you who want to work on engaging, hands-on projects that matter. So if you're ready to start building a high-paying, meaningful career, make your future happen. And go to dreamitdoittn.com to learn more about a career in manufacturing.
Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I was talking before the break, right, about how to invest in these volatile times. This is one of those areas when we see these big swings, right? 10% down in the first month and then a 10% up in the next 2 months, and we're right around a break even after the first quarter of the year. Now, where are we going from here? It's the question, right? Do we know? Do we know whether the market's going to go up or down over the next 3 months, 6 months, 1 year, and beyond? All right. Here's some things I will share with you. None of us know that. None of us have a crystal ball. But many of us are a little nervous about just what's going to happen. And the expectation is that it's more likely to go down than to go up, especially through the course of this year. All right, now let's look a little further out. If you listen to John Bogle. Now, John Bogle is in his mid-80s now, one of my heroes, still working every day. He is the founder of Vanguard Funds, one of the great, one of the biggest fund families out there. Tremendous amount of assets. And one of the things with John Bogle that I truly appreciate, besides the fact that he's still working in his mid-80s, and this is a man that had I think it was a quadruple or quintuple bypass back 30 years ago, and here he is going to work every day. Amazing man. And he's sharp as a tack. And one of the things that he has said, let me share something with you, by the way, about John Bogle as well. He was with Vanguard. They're the ones that first came out with index funds. Okay, like the S&P 500 index fund. All right, index funds were basically the passive approach to investing. As Dr. Fama, who won the Nobel Prize in 2013, this is one of the three-factor model he developed, which is now they've even added to and referred to now as a 4 or even 5-factor model. But it's basically how to, in fact, utilize certain asset categories in investing to minimize volatility and get the best return for your, for that reduced amount of risk. So for an example, if you compare it to the S&P 500 index, the S&P 500 index, if you look over the last 50 years, you would have a return of around 10%, but you would also have what's known as a standard deviation. That's a statistical measure, the amount of volatility of 18, which is quite high. That's why we have these swings that we're talking about even this year in the first quarter, but also where we see swings where you can have highs in the market in the 20-30% and more range, but you can also have lows that can be sub 20% as well, or even 30 or more. In fact, I'm going to share with you a little later some statistics over this century, if you will, from 2000 through the most recent 2015. Share with you how the returns of the S&P have actually fared and what the average has been for all that volatility. And it fits in with the narrative. John Bogle, as I mentioned, besides the index funds, and saying, as he put it, when they first were doing index funds, they were acting as fiduciaries, meaning they were acting in the best interest of their clients. But when Vanguard, and this goes with many, started over to active management and actively managed fund, he says we went from being, and these are John Bogle's words, we went from being fiduciaries to being salesmen. Okay? See, the goal is not to just what's the latest, greatest thing. It's proven strategies. It's about buying the market and holding it. And I'm going to show you some ways that you can do that as well. Now, the other thing John Bogle has said recently is the expectations. There's two interviews, two quotes I'm going to share with you from recent interviews with him. One of them was he said to expect, and this was a couple of years ago even, to expect 2 downturns in the market that could be from 20 to 50% downturns, bear markets, over the next 10 years. Okay, so that's like, oh my goodness, right? Who wants to go through that again? Because didn't we just do that 2000 through 2009? And I'll share those numbers, and the answer, of course, is that yes, we did. Right? Many of you probably had to withstand that kind of volatility. So the other thing that John Bogle said is that over the next 10 years, his expectations with regard to returns on the U.S. stock market's about 4% per year average. Now, let's see how valid that is. We're going to show you a slide here that shows the returns on the S&P 500 over the last, this is in fact going to compare equity mutual funds, asset allocation funds, fixed income funds, as well as inflation, the S&P 500, and the Barclays Aggregate Bond Index. So the S&P 500 index we've just talked about, and that is the column that is to the far right, the second one in. The furthest away is the Barclays Aggregate Bond Index, so that is to the bond market, if you will, what the S&P is to the stock market. And you can see in 2014, the bond market was about 5.97, the S&P about 13.69. Now, how did the S&P do last year in 2015? The answer is it only gained about 1%, and the Barclays was very comparable. So we saw a big downturn in 2015 compared to prior years. All right, what is this indicative of? And then you go into 2016 where we got this tremendous amount of volatility we haven't seen, again, since 1933. Now let's look at what the average equity fund, though. The average equity fund, which means the average investor, in other words, that was investing in stocks and bonds, averaged about 2% compared to the market return of around, for a similar investment, in other words, of about 9%, excuse me. So imagine now, I could have got 9% with a mix of the S&P 500 index and the Barclays Aggregate Bond Index compared to 2%, which is what the average investor got, which barely stayed ahead of inflation. In particular, if we're looking not at just CPI, but we're looking at the Everyday Price Index put out by the American Economic Institute, which really shows the kinds of things we spend our money on daily, like clothing and food and gas for our cars, and of course health care costs, which are rising at a rate of about 7% per year. Okay, so if you average those in, that's where you get into trouble, because what happens if your money doesn't make at least as much as inflation? You start losing that purchasing power. So let's take a look at the next slide. This is a graph that shows U.S. equity mutual funds. And as you can see, going back to 1972, the S&P 500 index would have doubled your return compared to what the average U.S. mutual fund, equity mutual fund, provided. Now, that's because here's how you get around this, all right? What we've determined, and this is the work done by Dr. Harry Markowitz, who developed what's known as the efficient frontier. And Dr. Markowitz, in his work on the efficient frontier, one of the things he found is if you put together asset categories that have a negative correlation, and that's what this chart shows. So it's showing basically by taking two different investments and blending them together that you can smooth out the volatility. Okay, and that's when one's up, the other's down. That would be, for instance, if you're comparing, let's go back to the previous slide on that one. So that would be comparing, in other words, small companies and large companies, and then one more forward. So on that one, so on the next slide forward, there we go. There's a hypothetical portfolio showing this negative correlation when an example would be, think of airline stocks and oil companies, right? When oil prices are really low and profits for oil companies are low, airlines that buy a lot of fuel are going to benefit from that, so they're going to be up. So now if you've had both those, then when one's up and the other's down, they smooth that out over time, and it gives you a more stable return with less risk. So now Dr. Markowitz, who won the Nobel Prize in 1990, developed what's known as the efficient frontier. So that's our next slide. And what it shows, again, this is showing the S&P 500 index, and if you look at it, the S&P 500, the little dot there on the far right, okay, that's not on the line, we're just below it, and it shows the average return over the last 50 years of about 10%, but if you go down to the bottom line of the graph, it shows 18, that's the standard deviation. Again, that's how much volatility, that's those big swings from big negatives and big positives. Now, if we go across to a moderate portfolio, that's the second one in from the right on your screen, that's that blending of small companies, large companies, of these companies that have a negative correlation, stocks and bonds, U.S. companies and international companies are examples of this. And you can see you can get the same type of return with about half the risk or volatility. So let's look at what that might look like, in fact, in a portfolio. So here is an example of a 50-50 balanced portfolio. This model portfolio is based on the work of Dr. Eugene Fama, who won the Nobel Prize in 2013 in economics for his equity research in developing the three-factor model. So he basically built upon Dr. Markowitz's work, who won the Nobel Prize in 1990, right, for his work in equities. And in doing that, what he found was if we blend what asset categories in fact would best be utilized and in what percentages to accomplish that goal. So an example would be, again, stocks and bonds, all right, small companies and large companies, value companies and growth companies, and international and domestic companies. So that's the part that's going to work the best. And then we put that together in a portfolio, and there's an example of that portfolio. This particular one at balance means 50% of it's in stocks and 50% of it's going to be in short-term fixed. Now comes the fun part, right? So let's think about this next part. I've got 50% of my market. We can go ahead and do away with the slides for right now. I've got 50% in stocks and 50% in bonds. Now, depending on how old you are, your risk tolerance, your financial goals, and all the rest as to what your actual mix may be. So if you're younger, you may have 80 or 90% in stocks if you have the risk tolerance for that and you're okay with the volatility. And if it's properly diversified, with the models I've just shown you, then you can help smooth out some of that volatility and get the best returns. Now, what if you're older? Okay, as you're nearing retirement, you may want to get much more conservative. Maybe you've only got, again, a 50-50 or only 40% or even 25% in equities and the rest in short-term fixed so that you can smooth that volatility out even further. Now, of course, the more equities you have in your portfolio, the greater the return, the greater the volatility. These are the trade-offs. You know, sometimes people come in and we have unrealistic expectations, right? We'd love to get, what if we could get something that was just 100% guaranteed? It was like a checkbook, you know, we just, you know, checking account. We could take money out whenever we wanted, and we could earn 6 or 8% or more on our money, and it was guaranteed. We could never lose money. The ideal investment, right? And unfortunately, it does not exist, okay? There are always going to be trade-offs. You're either going to take on market risk where you can lose money over periods of time, and depending on how you're invested, and this is why diversification is so important. That portfolio I showed you had 12,000 different companies in it, 12,000 stocks. Okay, that's a lot of diversification. Most portfolios, when people come in to see me the first time, maybe have a couple of hundred stocks. In fact, let me explain something to you, Jen. I'm going to offer this up, almost forgetting as we're going along here this morning. For the first 10 callers to my office this morning, 615-376-5325, I'll show you, in fact, I'll take a look at your current investment portfolio and show you how you, in fact, will do an investment analysis and show you how your portfolio compares with these model portfolios I've been talking about today, as well as sharing other strategies I'm going to talk about today. And I'm going to do a full financial plan for you. Okay, understand, I charge between $500 to $5,000 typically, depending on the type of account, the size of the estate that comes in, to do this same kind of works. And for the first 10 callers, you can get this at no charge. Not just a free consultation. I'm not just going to spend an hour with you and shoot the breeze and say thank you, see you later. No, I'm going to do a plan. If it's 1 visit, 2 visits, 3 visits, whatever it takes, a comprehensive plan to show you your financial future based on what you're doing. Will you be able to retire when you want to? Will you run out of money? We're going to answer those kind of questions for you. Is there a way to minimize taxes, reduce them even further? Another important question we'll answer. So all you do is call the office, 615-376-5325. Debbie's standing by right now. She'll take your information. She'll send you out a packet. It's a checklist of things you'll need to bring to your appointment with me to get the most out of our time together so I can do that planning for you. And I'll send you a free copy of my book, 7 Steps to Financial Freedom in Retirement, just as an added bonus for you. All right? So for the first 10 callers, 615-376-5325. When we come back from this break, I'm going to talk to you more about how this, and we've been dealing with theory. Now I'm going to take that theory and show you in real world practice things that you can actually invest in, things that you can use today to in fact get those results, to minimize that risk, minimize that volatility, and get the returns you need, that needed rate of return, to again maintain your standard of living, quality of life, never have to worry about running out of money during your lifetime. Accomplish the goals that you have, your financial goals for you, your family, whatever those goals might be. So join us here. We'll be right back on the Retirement Report.
April 7th. It's big news we know you'll love.
Our show's back on. And hooray for love.
The Oddest Odd Couple returns.
Oscar.
Felix, shut up.
For a flipping, funny new season.
Let's call it a night. Also, let's call 911.
Matthew Perry and Thomas Lennon star in the comedy hit.
Got it right in the ball.
The Odd Couple premieres after The Big Bang Theory Thursday, April 7th.
From your news and information leader, this is a News Channel 5 update.
Sort of a good news, bad news story on the east side of town. The good news is that injury crash that had blocked most of I-40 westbound around Donaldson Pike has now been cleared away. You see the traffic is starting to move there. The bad news is it created a 5-mile backup of traffic all the way almost to the Wilson County line, and it's going to take a little while for that to completely clear. Your drive time in from Hermitage on I-40 right now is at 44 minutes. From Mount Juliet, 60 minutes. That's a long time. Both of those are still quicker drives to downtown than if you take Lebanon Pike through Hermitage and Donaldson. And here we are at New Hope Road, just inside the Wilson County line, headed toward Hermitage. And you see these folks have not got the word about the clearing yet. So it's going to be backed up for a while. A number of crashes all over our map, but that's by far our biggest jam of the morning. Don't forget, starting at midnight tonight and on and off until noon Sunday, they're going to close 1 or 2 lanes of northbound 65 between Briley Parkway and Old Hickory Boulevard, weather permitting, of course, for blasting there. And they'll stop traffic both directions during the blasting times. Make your plans to travel around that if you can this weekend. That's 5 Live Traffic. Leland's up next with your forecast.
We're not telling you how to use your garage.
I am bored.
But you could fill it with awesome products from the Honda Dream Garage sales event, like the Odyssey or the restyled Accord. They're a 2015 IIHS top safety pick with standard rear view camera.
Thank you.
Get moving to your Honda dealer. You've got a garage to fill. Get a great deal at the Honda Dream Garage sales event. Now at your Honda dealer.
It's the final week of March Mania deals at Price Point Furniture. This week, save an extra 20% on all reclining sofa sets. Save hundreds on top quality bedroom groups, plus get a free queen mattress set when you buy any bedroom over $9.99. And get a great night's sleep with a free adjustable base when you buy this plush memory foam mattress for only $7.99. Get it all today with immediate pickup or use our express delivery. Only at Price Point Furniture in Madison and Murfreesboro. That's Price Point Furniture, where the price is the point.
Your pet. Could you love them any more? Probably not. But now you can give them even more when you save with Sentry FiberGuard Plus. With Sentry FiberGuard Plus, your pet is just as protected against fleas and ticks as with Frontline Plus. Because Sentry FiberGuard Plus has the same active ingredients but costs less than vet prices. And saving money helps you buy more tennis balls. Sentry FiberGuard Plus. Available at Tractor Supply.
Right now in Nashville, we have a partly cloudy sky. Currently at the airport right now, it is 58 degrees, relative humidity 75%. A wind northwest at about 8, 76.43 the high, the low for yesterday, and 0.68 in the Nashville rain gauge. Some of you, though, had a bit more than that, especially in Giles and Lawrence counties, where schools will close today due to some weather issues after the storms yesterday. Right now on the west side of town, 59 degrees, partly cloudy skies. On the south side at the zoo, overlooking the African savanna now, you're at 59. Later in the day, those temperatures hitting between about 65 and 70 degrees, so not bad for you this afternoon, about in the ballpark of what we normally would be. Average high for you today is 66, so this afternoon looks good. Now for tonight, a few more clouds are going to stream back in here. There may be a little shower chance in our southern counties tonight, but an overnight low of 43. Could be some patchy frost tomorrow night. We'll talk more about that coming up in a minute with our 7-day forecast. It's almost 8:29.
Your life is full of responsibilities, commitments, and plans you've made. But what if you were out of the picture? Would everything you've worked so hard for be protected? Would your family be okay? Now you can ask an expert these life and death questions and give yourself some peace of mind for free. Watch a special edition of Morning Line with certified elder law attorney Tim Takus. Monday morning at 8 on News Channel 5+. Follow News Channel 5 on Twitter and get breaking news anytime, anywhere.
Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we've been having a little bit of fun talking about investing this morning. All right, let's take another look at, I'm going to recap a little bit, the Markowitz Efficient Frontier. Let's take a look at that. All right, this is where, again, Dr. Harry Markowitz won the Nobel Prize in 1990 in economics for his equity research. What did he find? He found out in his research that if you combine certain asset categories, right, you could put together a portfolio that would reduce your risk, like stocks and bonds is a very good example. Compared to the S&P 500 index, right, those are, again, the 500 largest companies that make up 70% of the equity in the United States, outperform about 96% of equity mutual funds out there. So we compared that 100% stock portfolio to the moderate portfolio, which is about 50% stocks and 50% bonds. Okay, what do we find? And we get that same type of return, but with a much less risk or volatility. So again, at the next slide, it shows what that portfolio, the different breakouts that we would have. Now that, again, if you write it to the bottom line on the bottom of the page, 12,000 different companies, 19 distinct asset categories, 46 total countries. This is true diversification, a world portfolio, if you will. Now, that's showing then, we've come to all these theories and these things. Oh, this should work if you do these things. This is what you would get. This is what our back testing shows. Well, let's take a look at now a real-world example. This next is a spreadsheet that shows, in fact, the S&P 500 index. Now, what I did here was I actually put in this chart on the left of your screen the returns of the S&P 500. Now, not just the index, but an actual mutual fund. The S&P 500 index is a Vanguard S&P 500 index mutual fund that you could have invested in over that time, and this is the actual returns you would have received going from 2000. You notice that bear market from 2000 through 2002 when the market lost. So I started out with an initial investment of $250,000. I retire, let's say in 2000, or let's say I'm just in the market, right? I'm not retired yet. I'm not taking money out, in other words. So it drops 9%, then it drops 12%, then it drops 22%. In the first 3 years, my $250,000, I've lost almost $100,000 in that first 3 years in retirement. I'm getting tremendously nervous right now, aren't I? All right, I may be freaking out, in fact. Then the next year it starts going back up. How long did it take? In 2006, I finally got back where I started, a little over $250,000. I get $268,000, and I've been in the market for 7 years now. Then what happens? In 07, I gain a little more. I'm up at 282. And then what happens? Starting in October of 07 rather, through March of 09, the market drops over 50%. And in that 1 year alone, in 2008, I lost 37%. I dropped to 178,000. I lost over $100,000 in 1 year on my portfolio, and I'm way below where I even started now, what would be 9 years ago when I started at 250,000. What happened in 09? I start to regain a little, but I still don't even have my original investment back. I don't have that back until 2010. I've been in the market for 11 years, and all I'm at is about a break even. In fact, if I adjust for inflation, I've lost money still. And then I gained a little bit more in 11, 12, 13. How long, in fact, when we look at where I was at the top at 2007 at 282, it took me about 5 years just to regain that amount of investment. And I end up through 2014 at around 450. And of course, as I mentioned, the S&P only went up about 1%, so not much of a difference there. Maybe 458 by the end of last year. Now let's compare the balanced growth portfolio, this model portfolio, over that same period. Okay, there are a lot of ways to, by the way, put these asset categories together to attain this through a combination of institutional funds. You can do it. You can do it also using ETFs and mixing these together, as well as short-term fixed. And there are a number of instruments that can do that as well, both institutional funds and the like. These are no-load funds, in other words, that we're going to blend together, because what's what's the other part? We want to keep our costs minimal. That's what indexing is about. Just as with the S&P 500, one thing you can say, regardless of the volatility, and keeping in mind, right, this outperformed 96% of equity mutual funds, which means most investors that were invested through that period did much worse than the S&P. All right. Now, if we look at the balanced growth, where it's a more diversified portfolio, and we just jump ahead, the same thing. That same 3-year period where I lost money of almost $100,000, 2000 through 2002, I actually only lost about $1,400. That's a huge difference, right? So the very next year, in 2003, I'm only in the market 4 years, and I'm making money. I'm up about 20%, in fact, over that period. And then it grows and it grows, and then comes 08. Now, instead of losing 37%, I only lose 20%. I've got $345,000. I'm still almost $100,000 ahead of where I was with my original investment, compared to being down below by about $72,000 on my original investment. That's a difference of about $170,000 difference in my pocket. It's huge, right? And then we go on down, and we end up with 2014 at about 553. 2015 again was a bad year all the way around, but on this one it would have been somewhere in the neighborhood of about 560, 570 at that point. Still over 100,000 ahead of what the S&P did over the comparable period. All right, so let's take a look at the next slide. We're just going to breeze right through. This just shows a graph of what I was just showing you, utilizing this one, not just the moderate portfolio, but it's showing a conservative portfolio, which would be, say, 25% in equities, right? As we get nearer to retirement, as we're older, we want to be a little more careful with our money. We want to take less risk, less volatility. We don't have time on our side to be able to ride out market swings, as we just saw, that could take many, many years. So we might go more conservative. And we still, compared to the average of all mutual funds, that conservative portfolio did about double what the average. So in other words, if I took the average of all equity mutual funds, all you folks out there that are investing in mutual funds, right? How many are investing in mutual funds where you're just not getting those same returns? And you compare that to these model portfolios where I'm blending together, again, 12,000 different companies, 19 distinct asset categories, 46 total countries, and even in a conservative portfolio, how much better I would have done. All right. Now, one of the things that I want to cover with you is thinking in terms of risk. All right, we've talked about a number of different risks. When you're before retirement, those risks would be things like market risk, and a big one is inflation. So we're wanting to invest. We know we're going to take on market risk to stay ahead of inflation. Why? Because if we invest in things that are safe, typically, like the typical safe things such as savings and checkings and CDs and money markets, savings bonds, treasuries, which are less than 2% right now for a 10-year treasury. You're going to tie your money up for 10 years at 1.7 or 1.8%. My goodness. And we're talking in other countries, they're even talking negative interest rates, where you're going to have to pay them to hold your money. Okay, you're going to have to pay a fee to not lose money. Okay, which loses money. So obviously, and not consider the consideration of inflation coming in there as well. That's where Janet Yellen recently, she talked about the fact that they were even re-looking at that. They raised the interest rates in December about 25 basis points, or 1/4%, right? Then immediately, within the first, about a month later, they're already backtracking. And in an interview there, she's saying, a hearing rather, I think she was saying, we are looking at negative interest rates, similar to what Japan and other countries are doing right now. And then she came out most recently and said, we're definitely going to slow down this whole thinking of raising interest rates, meaning it'll be a while. And in fact, there are some articles and studies out there that are saying, if you look at many of the factors that are in the economy right now, this low interest rate environment, which we've thought of being temporary and largely due to Federal Reserve policies. And as the Federal Reserve chairwoman said, Janet Yellen, she was saying, one of the problems is fiscal policy. It's our government, in other words. Their fiscal policies making it a lot harder for us Federal Reserve people to, make things any better. We're getting our hands tied by the fiscal policy of our country. So there's one of the areas we need to fix, right? Good luck with that. So here, when's that going to happen? Here's the thing, though. How can you, in fact, take all of this information and use it to your advantage? Okay, when you see these things out there, it's not just to scare you. It's not just to make you nervous that I share this with you. It is to warn you, to say you need to pay attention. All right, but there are ways, in fact, that you can still make money. All right, in these times. Imagine, I'm going to share with you a couple of investment strategy. One of them was developed by Dr. Robert Shiller. He also is a Nobel Prize winner in economics. For his equity research, he developed what's known as the Cape-Shiller Index. And I'm going to share that strategy with you and how he has developed with Barclays a way to smooth out volatility to improve your returns without worrying as much about losses. And with that, I'm also going to share another index called the JP Morgan Mosaic. And this one I'll show you some numbers on as well. A couple of strategies of ways that you can make money even when the market's going down. Okay, so join us here. We'll get into that and more here on the Retirement Report.
If you were just in a car crash, the insurance company could already be calling you. Don't talk to them, talk to us. The call is free, and it could mean the difference between resolving your case for $5,000 or $100,000. Don't leave money on the table. Pick up the phone and call us right now. Ponzi Law, justice for all. 615-244-4321.
She stands in the face of evil and will not lose hope or faith. America, the land of freedom, is still the home of the brave. So raise the banner, call Old Glory. Let us join our fellow man. History will write the story. America will always stand. History will write the story. America will always stand.
Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right. I've been talking about all the things going on in the market. I showed you how to develop a portfolio. And in my book, in fact, 7 Steps to Financial Freedom in Retirement, one of the things I talk about is how the smart money invests. This is where you see pension funds utilizing institutional mutual funds the way I was describing and showing you in that portfolio for their pension funds, because they're looking at getting a desired rate of return, right? And they don't want a money manager bouncing it around. They're picking that passive strategy, just as John Bogle, the founder of Vanguard Funds, has promoted for decades, basically. All right. Now, one of the things that we want to look at with that is when you're looking at investing. Okay, we've talked about these positive returns, the volatility, how to get, in fact, positive returns. John Bogle, I mentioned, also saying that over the next decade, the expectation is for about a 4% annual return on your investments. Okay, Warren Buffett said the same, about expect single low digits. The Shiller Index, Dr. Shiller I mentioned, same thing. The Cape-Shiller Index has been very accurate in projecting out returns over the next over an 8 to 10 year period. And again, they're showing these low, 3-4% type returns to be the expectation in the U.S. stock market. So what do you do? All right, how do you in fact get around that? Well, let me show you one strategy for it. This is the benefit of a broadly diversified approach. Okay, through this, in fact, before I do that, let me do this. Again, for the first 10 callers, okay, you're going to want to see this. You know what? I will show you the strategy, then I'm going to put the offer up on the screen. So get a pen and paper handy to take down the information. But first, let me share with you one of the things that we do for our clients. All right, we bring you new strategies. We show you things that are proven, that have worked, tried and true over many, many years that I've been in this business. So this next slide is the benefit of a broadly diversified approach. This is developed by J.P. Morgan. It's called the J.P. Morgan Mosaic. And the way it works is that you start out with 12 different asset categories, okay? So in these asset categories, we're looking at basically a global type portfolio, just as I was showing you originally. So you're going to have with it commodity asset classes, American asset classes, German, Japanese, so we've got Europe, Asia, the United States, commodities, all of that together. And these are non-correlated assets. Remember what we said about non-correlation, right? We want that type of mix when we're developing a portfolio. Things when one's up, the other's down. Now we're going to how do we do this? The next part is what's known as harnessing positive momentum. Now this is a different type of strategy. This is quite interesting, in fact. So how do you harness this positive momentum? How do you know, right? How do you develop a strategy that you can see when things are going up and you can ride that wave and get that return? So J.P. Morgan developed its index. So they take these 12 different asset categories. Let's go to the next slide. And each month they look at the 12 asset classes, and out of those 12 asset classes they pick the top 6. Okay, those top 6 asset classes. Let's look at the next slide. This is on harnessing positive momentum. Those 6 asset classes that have performed the best, all right? So they start with the 12, they evaluate those, they say which are the top 6 performers with positive returns over the previous 6 months. They then weight those. They say, okay, now of those 6, which was the best performer with the least amount of volatility? And then the next best performer, again, with the least amount of volatility, and more of the money goes in those asset categories. Now, that's an interesting strategy, isn't it? And every month, that becomes your portfolio for that month. Then they do it again. They've got that, the computer algorithms built in there to where every month they look at the preceding 6 months, and that's the portfolio for that month. All right, now, does it work? Smoothing volatility to create stable returns. Let's look at the chart. Remember when I showed you the S&P 500 index from 2000 through 2002? That's when the dot-com bubble burst. The S&P 500 declined over that period 47.36%, okay, over almost 50% drop. Remember what I said about John Bogle, the founder of Vanguard Fund, and his projection, if you will, that over the next 8 years we can expect this to happen a couple of times. All right, well, we saw it back in 2000 through 2002, didn't we? Now, at that same time, when the S&P over that 3-year period dropped 47%, the J.P. Morgan Mosaic Index actually went up 17%. Imagine, all right? So if I got that $250,000 investment, instead of only having $125,000 over the period, or down, to about $150,000, I guess it was in that period, and wouldn't it be nice instead if I had a gain, okay, of about what was that, almost $50,000, right? That'd be kind of nice. How about the next period in 08? During the financial crisis of 08, the S&P 500 declined 56%. Okay, that's from October of 07 to March of 09, that total drop in that period, 57%, while the J.P. Morgan Mosaic Index would have grown nearly 8%. Okay, again, oh my gosh. Instead of losing over half of my money, I actually made money. I made 8% over that period. All right, well, let's take a look at the next chart. And this might be, that graph is kind of interesting, but let's actually look at it on a year-to-year basis. So in 1999, the S&P 500 index, the annual growth was 19.53%. Great year. The 80s and 90s, in fact, were the two best decades in the history of the stock market. Haven't seen them before, and who knows when, if ever, we'll see that kind of period again. Two best back-to-back decades. So when you're looking at if you're working with advisors, or you're reading things in the paper or magazines, or listening to the financial press, and they're talking about looking at the last 30, 40, 50 years, 80 years, and what the S&P has done, the stock market, and how great that is, keep in mind that's including that 80 and 90 period always. They're looking at the 80s and 90s, and you can see why. In that back-to-back decades, double-digit returns were the average, 15% and more. So you'd want to throw that in there if that's what your goal is. But I don't look at it that way. I'm going to look at what's my worst case scenario. Don't tell me about 30, 40, 50 years ago. I don't know if I have 30, 40, 50 years. I want to know, what about the next 5 to 10 years? What about next year? What can I do there? Well, let's take a look then. Now, the J.P. Morgan in 1999 only had a 3% return. So compared to the S&P at 19, not very good. So in that big positive year, what does that tell us? But then what happens the next year when the market dropped 10%, the S&P, or the J.P. Morgan rather, gained 5. When the S&P dropped 13, the J.P. Morgan Mosaic was up almost 5 again. When the S&P dropped 23% in the third year there, the J.P. Morgan Mosaic was up 7. Okay, so this is pretty easy. 17% return gain over that. So you can see during negative periods that the J.P. Morgan Mosaic is really working well during negative periods. Now let's look at the next year again. A big year in the S&P at 26%, and the Mosaic was up about 8. So when you have really big ups in the market, it's going to blow away this index, the J.P. Morgan Mosaic. But when you have really lows, it does really well. In fact, now in moderate years, it's pretty comparable. So in 04, when the market was up about 9, the J.P. Morgan about 6.5. When the market the next year was up 3, the Mosaic rather was up 8. 13 up 6, 3.5 up 6.6. So it fares pretty well in the moderate periods. Now what happened in 08 when the market dropped 38%? The J.P. Morgan was up 5%. Now you'll notice the index is a little off compared to the down was modified a little bit because of fees and such. But in 38% down versus 5% up, which would you rather have? Pretty easy, isn't it? Now go all the way down to the bottom, and this is the part, remember what we were talking about, right? What did Dr. Schiller say? What did John Bogle say? Well, I shouldn't say Dr. Schiller, but what the Cape-Shiller Index indicated, and what John Bogle said and Warren Buffett. They said these single low-digit returns. Well, what have we seen, in fact, since going back even 1999? If you look at 2000 forward, you basically got about a 3% average return on the S&P 500 index compared to a 5.5% return on the J.P. Morgan. Okay, so there's a strategy, right? Which, isn't that a nice strategy? Wouldn't you like to be able to utilize something like that? So here's one way that you can find out more about this, and that's call my office. All right, be one of the first 10 callers to my office. The number is 615-376-5325. Debbie's standing by to take your information. She's just going to get your address and be able to send you out a packet that's just some things you can fill out and a checklist of documents to bring to your appointment with me, okay, so that you can get the most. We want to do a comprehensive plan for you. I want to show you your financial future. We're going to do tax planning, investment planning, all of it included, okay, at no charge to you if you're one of the first 10 callers to the office. 615-376-5325. We'll also talk to you about Social Security. When's the best time to take it? Age 62, 66, 70? What about Medicare at age 65? All the different choices we've talked about before in the program. Do you even, I mean, it gets so complex. How do I minimize my costs there? We can show you how to save thousands, tens of thousands of dollars in those kind of choices with regard to your health care costs, and also how to make the most out of your Social Security decisions, minimize taxes so you can maximize your returns. All of this is a part of this planning, okay? And I'll send you out a copy of my book, 7 Steps to Financial Freedom in Retirement, just for calling in, all right? 615-376-5325. In my book, it's going to cover basically in the first few chapters what we do in the planning process, as well as we'll get into things like, it does get into, I should say, when I wrote the book, I basically looked at my practice over the last 25 years and I said, and try to put it in those pages to help people. There are even worksheets and everything as a part of that. Okay, how to develop that foundational financial plan, how to minimize taxes, all right? How to get the most out of your IRAs, how the smart money invests, long-term care, estate planning, it's all in there, okay? That, and then you get a personalized My Coaching when you come into the office as well. So when we come back, one of the things that I want to talk to you more about is some of these risks that we've been dealing with, and one of those, of course, is taxes and how to do tax-efficient investing, how that works as well to minimize taxes, which is going to keep, right? It's not just what you make, it's what you keep, and to keep more, you got to pay less to the IRS, don't you? All right, so we're going to show you how to do that when we return. Join us here. We're going to be right back on the Retirement Report.
You ready for this?
April Fool's.
It's game on with Deborah Messing in a no fools barred game. Then
Happens like this.
shut up! The joke's on me with one tricky magician. Plus, foolproof spring cleaning tips with Jeffrey Zakarian. Fabric softener for your baking
boom.
sheets? What? And an easy peasy pasta. Next, Rachel.
Today at 9 on News Channel 5.
After the storms of yesterday and last night, better weather today. Let's show you what is up this afternoon. Look for a high of about 69 tonight, down to 43. Meanwhile, for tomorrow, that number is at 62. 36 tomorrow night. Patchy frost possible by sunrise Sunday morning. 62 Sunday afternoon. Then another system providing the chance for some showers, maybe a few storms by the middle of next week.
It's our spring sale at...
The man behind Punk'd might get pied. Ashton Kutcher. And
it's time for the world premiere of the trailer for Finding Dory.
Plus, Ellen's Nowhere Go hits the Las Vegas Strip.
I would like to show you what you're playing for.
So exciting.
It is.
Today at 3 on News Channel 5.
Good morning. Welcome back to the Retirement Report. Been talking a lot about how to invest, right? And some new strategies that you can employ. And there's more that I didn't have time to get into, such as the Shiller Cape Index that Barclays has developed with Dr. Shiller, which is another way to reduce volatility and take advantage of momentum and getting a better return with less risk. You know, when you're risking the retirement that we have to worry about, things like market risk, inflation, outliving your assets, longevity. How do you make sure that doesn't happen? And how to take care of a spouse to make sure when the first passes that the survivor is still going to be able to maintain their standard of living as well. All of these things are so important. I hope we've been a big help to you today. I hope you join us here each and every week on the Retirement Report.
Middle Tennessee